everyone, welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Alex Wright, manager of the Fidelity Special Situations Fund. Hi Alex.
Hi.
So I thought we'd take a look at past performance, both of the fund and of the market itself. The last 12 months have been very jumpy, not just in the UK, I hasten to add, all across the world. Is this the new norm? Are we just going to have to get used to volatile markets?
I think volatile markets is something I've always had to deal with since starting to run money in 2008, and this year has just been very much a continuation of that. I think that the world is obviously in a reasonably low growth phase with high levels of debt as a whole, and I think the volatility continues to reflect people's unease with that. But that doesn't mean there aren't good gains and possibilities for making money in these markets, as there have been over the last 5 years.
Absolutely, it's been a fantastic bull run, and a lot of that has come from growth stocks. However, there's some evidence to suggest that for the last 4 years, growth has outperformed value, but year to date, value seems to be doing better. Is that something that you're reflecting in your portfolio?
So you have started to see a sort of a tentative turnaround in some of the value performance, which is very good for me because I run a value mandate. So it's been a big headwind to performance, dealing with the fact that a number of the growth stocks, which I think are very expensive, have been outperforming. And that was a particular headwind for the performance over the last couple of years, which is turning around somewhat. But as you say, it's only been 1 quarter, it's very early days. And I think the valuation gap between growth and value is still very large. So still a lot of opportunity for me, that I'm seeing a lot of new ideas still in the markets for the type of stock that I like to invest in.
You say that sounds like you're optimistic, and I think you must be, well, the only one within the sort of UK equity fund managers. I've spoken to a number of big high-profile managers in the last week who say that they're finding it increasingly hard to find compelling UK equity investing ideas. That may well be because they were, invested solely in large caps, whereas you're a flex cap manager. But would you agree with them? Would you say actually yes, because of the rally that we've had, things are getting harder to find these opportunities?
No, I'm really not seeing that, actually. So I'm still seeing lots of new ideas right across the market cap spectrum. And if anything, actually migrating the fund somewhat up the market cap spectrum. So particularly in the sell-off we saw earlier in the year, adding to some big names, the likes of Lloyds, CRH, some really undervalued stocks, which are right up the market cap spectrum. So I think when you're looking for value stocks, staying away from staples and utilities, which I think have been well owned by other managers, where I do see a complete lack of value, but that's not new. Stocks have been expensive for a while, where I think the opportunities in particular sectors like banking or other cyclical sectors are still really good today.
You mentioned there that you've been looking more at sort of larger cap stocks. When we last met in October 2012, you said that smaller companies were cheap and in rude health. I expect they're still, the health of smaller companies hasn't necessarily declined, but I imagine they're not so cheap anymore.
Yeah, the valuation gaps across the market have really closed up, actually. So at the time, smaller companies were substantially cheaper than the middle large cap companies. And today, actually, you're seeing more or less the same type of valuations right across the market cap as a whole, although actually there are huge dispersions within sectors, with some sectors looking extremely expensive, but others looking really cheap. So I think, yeah, as a whole, the market doesn't look amazing value, but there are a lot of valuation opportunities within that.
And what's driving that? Is it the oil price? Is it people's hunt for income? Is it just a sort of stock-by-stock basis?
I think the hunt for income have definitely priced up a number of sort of perceived safe equities to very high valuations. So that reflects the fact that bond yields are so low, and a lot of natural owners of bonds have started to move into some of these perceived safer stocks. But actually, I think the valuations you're forced to pay for those mean that the degree of safety there isn't actually as good as you might think. And so that's an area I've really been steering away from.
Alex, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.